In London. Here are your top stories. More to come. The Fed raises 75 basis points, signaling flexibility on future hikes. Markets rejoice, even as economists see a hawkish Powell. Friends no more. Advertising woes hit Facebook parent Meta as it reports its first ever quarterly sales decline. Plus, shelling out. The oil giant posts another record profit and announces a $6 billion buyback for the third quarter. We're going to speak with the CEO this hour. Let's take a look at the futures then as we weigh up a mega day for earnings. $9.4 trillion market cap reporting today. The futures pointing up on the back of a stellar session over in the States. Gains of 0.6% across these European futures. Again, of course, Jay Powell hiking 75 basis points. That was not unexpected. It was the guidance again and the views. This divergence between the economists on the one hand who said this was a hawkish Fed, and the emphasis again on looking back 6 weeks to the dot plots. That came from Jay Powell. 3.4% by the end of this year, according to the dot plots, 3.8% by next year. But that is not how the markets are interpreting the guidance that we got from Jay Powell. The Spanish IBEX currently up 0.7%. Worth noting, by the way, there was some optimism around the Asian session as well. You've seen gains, the benchmark there of about 0.8%. The Spanish IBEX up 0.7%. We'll be looking at Santander. The CAC 40 is gaining 46 points. That's a gain of 0.7%. Here in the UK, the FTSE 100 up 0.6%. Oil is higher today. We'll be talking about the Shell story, of course, as we mentioned, speaking to the CEO. Let's switch it on, see how things are playing out then, and whether or not you can see a build-out of the gains that we saw yesterday on Wall Street. Again, just for the context, NASDAQ ending up more than 4%, the S&P 500 ending up around 2.2%, and a drawdown in terms of the yields at the front end. The NASDAQ futures now pointing lower by 0.5%. The two-year stateside 280 currently, not a lot of movement, just 1-2 basis points, and of course that divergence in terms of the yield inversion between the 2s and 10s, that still remains. The Bloomberg Dollar Index, you saw some softness yesterday, some relief then across the currency space. We saw that reflected in the yen. Last time I checked, it's at 135. The Bloomberg Dollar Index is down by 0.2%. Is the end of that short move of the yen is a question. The Brent picture, 108, you're seeing gains of 1.5%. Elevated prices once again. WTI, the last time I checked, just below $100 a barrel. Coming up then, on the biggest earnings day of the season, we will be speaking to, yes, the CEO of Shell and Anglo American this hour. 2 major interviews. Plus later, the bosses of Stellantis, Etihad and Accor. Let's get over to Bloomberg MLive Managing Editor Mark Cudmore. And Mark, you've been looking at volatility in the bond market.
Yes, Tom, one of the big takeaways from last night is that forward guidance has been explicitly dropped by the Fed, and that means we're much more data dependent going forward, and that means much more volatility in the bond market and the yields market as they swing back and forth in every fresh data print that changes the picture. Now, this is the MOVE index. It's a weighted index of 1-month implied options across the yield curve, US yield curve, to kind of show what an implied volatility index is. The index. Now, you can look over the past 10 years, apart from a couple of weeks during the first stage of the pandemic, we seem to be in an unprecedented regime. Volatility has exploded from earlier on this year and stayed quite elevated. Sure, in the last couple of weeks it's dropped back a bit. That's because we were very well guided into yesterday's meeting, and it's summer market, so this can come down a little bit further. But I think some people think, hey, this is an outlier. We can't stay in this high volatility world forever. We need to return to the regime of this world at some point in the future. However, if you put this chart on a longer term time frame, i.e. going back 30 years, Thank you very much, Valerie. You can see that what we're doing is we're going back to the world pre-forward guidance, back to in the 90s, early 2000s, when genuinely the data did matter. That's when I learned to trade, and that's when you did trade off the data because it would change what the central bank would say. It wasn't about their pre-mentioned forward guidance. So this line will not revert back to the last 10 years. We're in a true regime shift change. We're going to stay elevated for the next few years. Sure, it might come back to 100 or maybe even a bit below her, but generally volatility is staying elevated for the next couple of years.
A trip down memory lane there for Mark Cudmore, Bloomberg's MLive managing editor. Of course, bond market volatility to remain elevated. The bear market in the bonds is not dead yet, is the call from Mark Cudmore. Right, the knee-jerk relief that we saw in markets on possible crumbs of comfort from the Fed outlook echoes a pattern seen after earlier hikes. To dive deeper into the market reaction, let's bring in Bloomberg's Dana El-Baltaji. Dana, what do you make of the moves within these markets? Are they getting ahead of themselves? Is it premature? Are they starting to price in a pivot that will not come?
I absolutely agree with what Mark is saying, that basically what we have from the Fed is a fueling of the sort of volatility that we will likely see. And it's that sort of nightmarish markets that we've experienced in the last 6 months. I think we will see a lot more of that going forward. All of those companies that have had a hard time accessing markets in order to raise cash will likely find it even harder now, with the Fed basically saying, we don't know what's going to happen next. We will act as and when.
And the data that you're going to be focused on then, up until that September meeting, and of course he's left the door open to another 75 basis point hike. He said that decision hasn't been made. Where is your focus going to be on the data picture?
Literally every single point will make a difference in markets, from jobs, from earnings on bonds, from earnings from investments, from how many companies will actually come and sell bonds. All of these things will matter significantly, because at the end of the day, if people lose their jobs, it doesn't matter what the Fed or anybody else does. People cannot afford their loans, they can't afford their mortgages, and that will have a knock-on effect.
And yet the job market, and he re-emphasized this, remains very, very tight indeed. In fact, when he was asked about recessionary risks, no to the question of is the US in recession, and number two, of course, the tightness in that labor market and the lack of workers, new workers coming into the labor force. That is going to remain supportive, is it not?
Absolutely, for now, and that's the really important thing. Everything is for now, and for now, things look good, but we don't know what they will look like in 2 months' time when companies who have not actually, taken into account fuel prices this high and the possibility of gas prices going through the roof, they haven't actually budgeted for that. So how do you do that when markets are too expensive to access and you can't raise cash?
So there's a disconnect, clearly, between the markets. And maybe they're looking at some areas where you're seeing a little bit of softness in the economy, whether it's new home starts, for example, higher mortgage rates, or some of the softness in the inflation picture. But that isn't valid at this point. You need more clarity.
You absolutely do. And that's why every single point, every single number that comes out sways markets. And that's the kind of volatility that Mark is talking about.
Dana, thank you for painting a nightmarish picture for us. I'm quoting you there. Dana, thank you very much indeed. The analysis there on the market reaction, of course, to the guidance from Fed Chair Jay Powell, that 75 basis point hike. Okay, coming up, Anglo-American reports a drop in profits and shareholder returns as the industry battles falling commodity prices and ballooning costs. We're going to speak to the CEO, Duncan Wanblad, next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. In the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open. Happy Thursday. We are 9 minutes into the European trading day. You're seeing gains of 0.5% across the European benchmark after a very solid handover from the US, weighing up, of course, earnings and that decision by the Fed to go 75 basis points. And, of course, the guidance from Jay Powell that maybe another big hike is in the cards. But, of course, they are remaining data dependent. On the earnings front, Anglo-American, that stock currently just checking up 4%. So the stock for Anglo-American currently up 4%. That company, the biggest miner, is, of course, reporting a drop in profits and shareholder returns as the industry battles those falling commodity prices and ballooning costs. Joining me now is Anglo-American CEO Duncan Wanblad. So, Duncan, we're getting an upside lift in terms of the stock this morning of about 4%, as I said. When it comes to the results, you did beat in terms of the estimates, but adjusted earnings per share, $3.11 versus $4.30 year on year. Again, beating the estimates. Adjusted profit coming in at $3.79 billion, $3.79 billion, down 29% year on year, but again, a beat on the estimates. Does it get worse from here in terms of profits, Duncan?
Good morning, Tom, and thanks very much for having me. Look, turbulent times, as you've been saying all morning. Absolutely, you know, the business has seen that. But let's not forget that these are the second best half-year performances that we've had in this group ever since the group started 105 years ago. So really, really pleased with the outcome, actually. The fact is that the business is in really robust shape. You know, we've set ourselves up to wear storms like we're going through at this particular point in time. You know, our strategy is set based on the long term. The business or the world is going to need all the commodities that we produce. If we have any chance of reaching 2 degrees C from a climate change aspiration point of view, let alone the 1.5 degrees C, needs all the metals and minerals that we do. And when we set ourselves up bearing in mind that we will go through cycles such as the one that we're going through at the moment. So I think we're in really good shape operationally to move through the second half of the year. But of course, you know, things are going to get a little bit tough from a cost point of view. Inflation is here, and we're going to have to weather that storm too.
Okay, well, let's kind of unpack your views on costs then, because it is so important across, not just within your industry, of course, but globally across many different industries. Is it your view that the costs are coming close to peaking? What realistically can companies like yours do to kind of rein in those expenses?
Yeah, great question. So look, hard to say whether costs are peaking or not. As I say, it's still very noisy out there, and there's a lot going on geopolitically all over the world, and that has a meaningful influence in terms of how costs are going to pan out over the next little while. You know, what China's going to do, whether there's going to be any stimulus there in the short term or not, is also going to play out into that. But realistically, you know, we have to focus on things that we can absolutely control. We have a couple of really good processes and systems in place in terms of managing that. We call that our operating model. and that ensures that we are managing every operation as close to the limit of its capability as we possibly can, safely, of course. And that helps us manage the costs. We have a good technology program that we're deploying in the long run. That goes to service costs and the sustainability of costs. We've just managed to reach a really good wage negotiation settlement with some of our biggest labor unions in South Africa. That's a benchmark 5-year labor agreement, and that's very helpful in the short run in terms of managing some of these costs.
Okay.
So I'm not ready to say that there's any structural change in the cost base yet, but we have to be ready to manage it.
Okay, you need that flexibility, of course. Duncan, when it comes
Indeed.
just looking at this environment, all these concerns around recessions, do you have to be more cautious on growth and on deals going forward?
Yeah, Tom, so we've always had a very balanced view in terms of how we deal with our discretionary capital. And to the extent that the projects are ready to go and they represent good value and we can afford them in terms of the robustness of our balance sheet, we will tick them through. And I don't think that anything is going to change in terms of our approach and the discipline that we apply to allocating capital. But absolutely, in a world where margins are starting to squeeze because prices are coming down and costs are going up, one has to be very thoughtful about when you allocate that capital. It's not so much that the projects don't happen, it's just how they happen, and that's what we've got to do. I really think about the worst thing that the industry could do today is just stop developing. I mean, if you think about what the world needs, this transition is going to rely very much on the metals and minerals that are produced from mining. So stopping it's just going to create a really big problem at the end of the day. But managing it carefully and in a disciplined way, that's also important.
Net debt has risen this year quite significantly. Are you comfortable with the balance sheet at this point as we head into a tougher kind of macroeconomic environment?
Yeah, very much so. I mean, our net debt rose to about $4.9 billion, and that's more or less where we expected it to be. A lot of that is underpinned by the pricing that we saw at the beginning of the year, and our balance sheet remains very robust and quite flexible, actually. So no concerns from my side in terms of where we are in the cycle right now.
Okay, I'm going to fold two questions into one when it comes to the question of China, Duncan. Before we let you go, are you seeing any pick-up in demand out of China in the second half? And have you had any conversations with the government about this state-run company that it seems they're putting together to potentially control the purchasing of iron ore?
Tom, I'll answer the second bit of the question first. No, we haven't at this particular point in time ourselves spoken to the country about that notion. Realistically, I think our products service a very niche market. We have very high quality iron ore. We're not as exposed as others are to China in terms of where our products go. Of course, we'll watch that very carefully. In terms of the demand picking up in China towards the second half of the year, look, very hard to call exactly the time when that's going to happen, but our expectation actually is that there should be some easing in China. There is capability for easing to happen in China. And whether that's going to be in the next 6 months or the 6 months after that, I think the environment is ripe for that a little bit. So we do look forward to that.
Okay, looking for some easing out of the world's second largest economy. Anglo-American CEO Duncan Wanblad on that beat in the earnings. The stock currently up 3.2%. Thank you. Okay, coming up, oil giant Shell posting another record quarter. We're going to interview the CEO, Ben Van Beurden, next. Stay with us for that conversation. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open. We are 19, almost 20 minutes into the European trading day. You're seeing gains across the benchmark of 0.5%. Future stateside pointing to losses just of about 0.1% after a very strong rally yesterday. Let's get back to the earnings picture then. Shell has accelerated share buybacks after reporting a record profit for a second consecutive quarter due to high oil and gas prices. It is the latest sign of how Russia's invasion of Ukraine has delivered a windfall for investors and major energy producers, even as the soaring costs of fuel batters the wider economy. Ben van Beurden, of course, the CEO of Shell, joins us now. Ben, thank you for your time this morning. Your assessment of these results, how they position the company going forward. Is this the peak in terms of earnings this year? Does it soften from here, given the recessionary concerns, given the slowdown in consumer spending?
Well, thanks, Tom, for the opportunity to be on your show today. Let me say a few things. Of course, it's very hard to sort of look into the future. I'm not going to give any guidance in that respect. But first of all, let me talk about the energy markets. The energy markets are tight and will remain tight and volatile, I think, not only for the remainder of this year, but also well into next year. I heard you talk a little bit about a windfall because of the situation in Europe. But if you look back to the last time we had oil prices like this, which was 2013 first half, the company has done a tremendous job in getting more disciplined and more resilient. So we've had significant high grading of the portfolio, $82 billion worth of assets divested, much more discipline on capex, down almost 40%. Down on OPEX, 11%. So, you know, a lot of the improvements that you are seeing today is a lot of hard work over the last decade and not necessarily just a windfall. Where will it go from here? Let's see. But I'm quite optimistic, both on the energy system as well as the global economy.
Well, let's talk about pricing, because you touched on it there. We're looking at Brent currently $107 a barrel. I know you'll be reluctant to give an accurate or a clear forecast, but just approximately, where do you see continued tightness? Where does that leave oil prices towards the end of the year?
Well, it's very hard, as you know, to make precise assessments. And there's a lot of volatility out there. And there's also all sorts of other factors like uncertainty and maybe a certain degree of concern and fear weighing into the oil price. But let's look at the facts. Yeah. So demand hasn't fully recovered yet. And supply is definitely tight. There is a lot of talk about limited spare capacity in OPEC+, and we subscribe to that theory as well. There is not a lot that can come out of, say, shales in North America. Of course, the release from the Strategic Petroleum Reserve has helped a bit. But listen, that's not a price management tool, so there's a limit to what can be done there as well. And even though, of course, we focus a lot on Russia, as a matter of fact, the amount of crude oil coming out of Russia has not really diminished an awful lot. That might still come, of course, when the sanctions start to bite next year. So I think where we are today, there is more upside than downside when it comes to the oil price.
Are you seeing any signs, Ben, of demand destruction?
Well, I think you see demand response. Yeah, and what we see, for instance, U.S. gasoline demand is down a few percentage points compared to 2019. And of course, we see still a little bit of lagging effect in China because of COVID and the rolling lockdowns. And there's some areas where the recovery has not been complete, like still, for instance, in aviation. But demand destruction on the liquid side, no, because there is very, very little elasticity when it comes to that. On the gas side, that's a different story, though. What I do see, particularly in Europe, of course, with the very, very high gas prices that we are experiencing at the moment, we see a lot of LNG being bid away from Asia into Europe. But of course, there is limited supply coming on, extra. So there I would see an accelerated transition away from gas into renewables. But that is not something that will happen in a matter of a few quarters. That will take a little bit longer. In the meantime, I think the fundamentals for LNG will remain very, very buoyant for years to come.
Okay, fundamentals around LNG remaining buoyant. Ben, you are the most valuable, the biggest company here in the UK. You're listed here, record profits, buybacks. Is there more that you can be doing? Is there more that Shell can be doing to help consumers around this country, households that are feeling the pain of higher energy costs? We're talking potentially £500 a month on utility bills towards the end of this year. There's more, surely, that Shell can do.
Well, and we are doing more when it comes to that as well, Tom. So, of course, we are in energy retailing, in gas and electricity. And of course, we do have hardship funds. We do help people who struggle the most with these high gas and electricity prices, with payment schemes and with all sorts of tools to help out, payment holidays, rescheduling, and everything else. But fundamentally, of course, you have to bear in mind that the issue that we are facing at the moment is a wholesale tightness in the market and a little bit of a design problem with the energy markets here in the UK. So in addition to changes to the energy market design, which I think are now on the cards and happening, what we should do as a company is to bring on more supply. And that's exactly what we are doing. So we are repurposing the Pierce oil field to a gas blowdown, new gas coming on in this autumn already. We just sanctioned Jackdaw, another significant gas supply in the UK. And of course, we continue our investment in renewables as well. We have earmarked £25 billion for this decade, 3/4 of which, by the way, goes to energy transition spend. And I think that will, over time, provide relief. But we have to bear in mind, some of the tightness is legacy and therefore cannot be resolved in a matter of weeks.
Ben, I've got like 15 more questions, but we're running up against a hard break. We appreciate your time. It's an earnings beat, of course, profits at record levels, and a return of cash to shareholders. Ben van Beurden, the CEO of Shell, thank you. Coming up, the US economy is not in a recession. That was the message from Fed Chair Jay Powell. We're going to speak exclusively to Sean Haggerty, Managing Director of Vanguard Europe. That is next, of course, the major money market, the major money manager, I should say. Of course, and all things central banks, how to position around recession risks. Stay with us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. More to come. The Fed raises 75 basis points, signaling flexibility on future hikes. Markets rejoice, even as economists see a hawkish Powell. Friends know more. Advertising woes hit Facebook parent Meta as it reports its first ever quarterly sales decline. Plus, shelling out, the oil giant posts another record profit and announces a $6 billion buyback for the third quarter. Let's check in then on these markets. It was a very solid session stateside. The Nasdaq ending up higher than above 4%, the S&P 500 ending up around 2.2%. But you had that split between the economists' view that this was a hawkish Fed and investors who are now looking, potentially pricing in something of a pivot from the Fed. Are they getting ahead of their skis on that front? Here in the European benchmark, you're looking at gains of 0.6%. The DAX over in Germany up 0.2%. The auto sector, by the way, one of the best performing. We'll break down the sectors for you in just the next few seconds. The FTSE 100 gaining 18 points, 7,366. Basic resources and energy, something of a propellant there. And of course, we've seen that strong set of results from Shell. Here's the sector breakdown now. Basic resources at the top of the list, up 3%. It's worth noting that yields came off, particularly at the front end yesterday. There is still that yield inversion, pointing, many would say, to a recession between the 2s and the 10s. But the softer yield picture, of course, positive, particularly for the tech sector. Real estate coming in with gains of 2%. Autos and parts, as I said, something of a support there across the DAX, up 1.7%. At the bottom of the list, you've got food and beverage, telecoms and utilities. Currently 3 sectors in the red. Let's change it on, see how things are playing out. Of course, a couple of the movers. A big day, of course, for earnings, a massive day for earnings in terms of around $9.4 trillion of market cap for companies that are reporting. We talked, of course, about the energy giant, or as the CEO told me in the break, the renewable transition company that is Shell. You're seeing a gain there of 1%, just over 1%, 22 points on Shell. Buybacks, of course, increased to $6 billion, as we said, another record set of profits. The CEO telling me that they are doing all they can to alleviate pain at the pump for consumers. But of course, this is a company that faces that windfall tax. Many policymakers here in London will suggest that maybe these record profits just underscore that need for that additional tax. Nestle, well, they came in. It was a beat on the top line. There's concern about margins, though, going forward in the face, of course, of those concerns about a recession and weaker consumer. Currently down 1.7% for that food giant. Anglo-American, the mining giant, gaining more than 4.5% on the back of a beat there as well. There is, of course, a question around softer commodities going forward, higher costs as well. But the top line, it was a beat for Anglo-American, and so far, investors rewarding those numbers. Right, the Fed has delivered the widely anticipated 75 basis point rate hike and signaled increases will continue until inflation is clearly heading back down.
As it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. And we're going to be making decisions meeting by meeting. We think it's time to to just go to a meeting-by-meeting basis and not provide, the kind of clear guidance that we had provided on the way to neutral.
That, of course, was Jay Powell on the back of that decision to raise rates by another 75 basis points, saying they are going to take each meeting and meeting by meeting on the data, of course. Not ruling out another mega hike of 75 basis points, but saying it will depend on what happens between now and September. Sean Haggerty, Managing Director of Vanguard Europe, joins us now, I'm very pleased to say, for an exclusive conversation. Sean, I want to start with your views on what we heard there from Jay Powell and the disconnect we seem to be getting from the economists who viewed this press conference as hawkish and the markets, of course, stateside, rallying, maybe starting to think about a pivot, certainly some in the markets pricing in cuts as early as 2023. What do you make of that divergence, first of all?
Well, what I make of that divergence is, of course, we don't know. And I think that in the short term, you're going to see people who are going to try and do what they do, is watch the Fed and see what that means in the short term. Honestly, I'm here because I represent a bunch of retail investors. Vanguard has over $7 trillion in assets under management, and most of that money is retail investors who, amazingly, if you look at what they do from a purchase and sale perspective, it hasn't changed that much. I look at the UK business we have, and over the past 4 years, the sale activity in the first half of the past 4 years has been about the same. And so I think what's amazing about this is, although there's a lot of gyrations, although there's a lot of movement in the market and professional investors do have to pay attention, what's important for us is that there's a lot of stable money out there from retail investors. And I think that the European Union and the UK actually have to think about how do we actually increase the amount of capital market participation that we see from those retail investors that actually creates more capital, that creates more innovation, creates increases in productivity that make it for a better economy and probably more stable economy in the future. So there's a lot of short-term volatility, and our views are important when we're thinking about how we manage active fixed income funds, or our sub-advisors, how they're managing active equity funds. But what we want them to focus on is long-term value creation and not worry so much about seeing around the corner in the next few months, but understanding what's going to happen in the next few years.
That's a longer-term picture, and arguably very valid as well. But when it comes to the here and now, are you seeing any signs that those retail investors are becoming more cautious in the face of this cost of living crisis, recession, and double-digit inflation?
Yeah, I would say that what's going on is there is a little weakness in flows on the fixed income side. So I think it does surprise some market participants who are saying, gee, I'm in a fixed income-oriented portfolio, and I'm seeing pretty significant losses. Obviously for the first time in maybe decades at this level. And so we do see a little weakness in the cash flows there. And the equity flows actually have been somewhat more resilient. And so you would wonder, is there capitulation in the equity markets at the retail side? We would say so far, no.
Okay, you've got assets under management. You've grown them from 2017 levels from about 148 billion US dollars here in Europe.
In Europe.
It's much bigger, of course, globally.
Yes.
To 243 billion. Do you have a target for the year ahead? Where do you expect that AUM to get to over the next 12 months?
Yeah, at Vanguard, we're pretty clear we don't have targets. What we try and do is we just try and serve the investors, give them a really good outcome, and then what happens, happens. We find that sometimes when you hit target or try and set targets, you have unintended consequences, you have misaligned incentives. And so for us, the incentive is just serve our clients really well, try and drive the cost down, try and improve their outcomes, and, come what will.
You're hiring in the UK, you're hiring in Germany.
Yes.
Any question marks about pursuing those plans
None.
In light of the recessionary fears?
None.
You continue to hire?
Yeah, we call this Vanguard weather. Okay. And so we think that when the going gets tough, the tough get going. And so we have a very long-term outlook. And, we look at these businesses as 100-year businesses, not worried about what's going to happen in the next 6 months.
Is the 60-40 mix still the most popular product in Vanguard? Does it hold up in this environment?
It does hold up in this environment. We think it holds up. Again, when you're looking at, think about what we represent. We represent individual investors who, for the most part, are investing over a very long time horizon. And so for those investors, the 60-40 portfolio is still absolutely the best thing to do because equities are the best long-term inflation hedge, after all, and the bonds serve as a ballast to the volatility that you get from the risky asset in the equity side. And so, we've seen a 6-month correlation of negative returns for equities and fixed income, but that is unusual, as I think anybody who knows the markets knows that it is highly unusual. Therefore, if you look over the 10, 15, maybe 50-year time horizon that some of our investors have, 60-40 is still very much alive and kicking.
60-40 still has legs. It was only a couple of weeks ago that we were facing record high temperatures here in the UK and across much of the rest of Europe. Talk to me about climate change. There's been some criticism of Vanguard and other asset managers that you're not doing enough around reducing CO2 in your portfolios. Extinction Rebellion, one of the protest groups, has been targeting your company right here in the City of London. Do they have a valid point? Is there more that you can be doing to pull back on those CO2 parts of the portfolio?
I think one thing we agree on is climate change is a significant risk, and that we all need to be doing our bits to try and think about how do we mitigate
what does
that
that
risk.
look like?
And so what that looks like in our case, and you know, reasonable people can disagree. And I think some would say divest of securities, and with the hope, I think that would change the cost of capital maybe for producing carbon. We actually disagree. We actually think the best way to do this is to own and engage. And so we are, through our engagements with some of the big integrated oil companies or some of the other companies that we own, to try and understand how are their boards governing the risks associated with that company. And we think climate risk is the most material risk facing most companies today. And so we're doing a significant amount of engagement with those companies to try and understand what are they doing to ensure that they're disclosing the risk, that they're measuring the risk and the potential issues that they might have for creation of long-term value, and then what are they doing to actually mitigate that risk and try and reduce their carbon footprint. And we have signed up for the Net Zero Asset Managers Initiative, which is essentially saying we think our companies that we own should be thinking about aligning themselves to the Paris climate agreements.
There's leverage you can bring to bear, given the holdings you have across these boards. Are you prepared to be more aggressive?
I think we have been aggressive in terms of trying to say that we expect our portfolio companies to align to Paris, and we do hold them to account to that. And I think we have good constructive conversations with boards about that particular structure. And what's really important here is that I would look at what's the temperature change projected on the FTSE All-World Index Fund. That's what we should care about, not an asset manager who maybe sells all of the stocks and has a potential net zero by 2030. Well, if the whole world is still going to 3 degrees and somebody has a portfolio that's going to 1.5, well, who cares really about that portfolio? You can feel good about that, but that's not actually instituting change. We think let's own the whole companies, all of them, and let's try and drive the entire economy towards where Paris, I think, agreement would say we should go.
Okay, Sean, fantastic. So thank you for coming to the studio
Thank you.
Of course, that need to pull more retail investors into the business, of course, the space, the capital markets here in Europe, and of course, seeing that demand still and the build out of the business across Europe. Sean Haggerty, Managing Director for Vanguard Europe. Thank you. Let's bring in the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Democrats in the US have struck a deal with holdout Senator Joe Manchin on a tax, energy and climate bill, breaking a deadlock and legislation to enact major parts of President Biden's agenda. The plan raises some $740 billion in revenue over the next decade, with more than $430 billion in spending and the rest to reduce the deficit. Gazprom cut natural gas supplies to the EU via the Nord Stream pipeline to about 20% of the route's capacity yesterday. The Russian company says the pipeline needs 5 functioning turbines to run at full capacity, but only 1 is in working condition. Natural gas prices are more than 10 times higher than their usual level for this time of year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins here in London, thank you. Coming up, big profits for big oil. Yes, Shell and Total Energy reporting this morning. We break down the numbers next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. We are 45 minutes into the European trading day. You're seeing gains there across the benchmark of 0.5%. The best performance currently in the FTSE MIB, the Italian index currently gaining more than 1%. The futures in the US, the S&P E-minis down 0.2%. Nasdaq futures down 0.6%, of course, after the Nasdaq posted gains of more than 4% yesterday. We are weighing up all of these earnings, and the focus now switching to energy, oil and gas, and big oil set for a record-breaking $50 billion profit in the second quarter. That as a direct result of the high energy prices that have stoked inflation and put pressure on consumers, prompting calls and the implementation here in the UK of windfall taxes. Shell has accelerated share buybacks after reporting record profit for a second consecutive quarter. We spoke with the company's CEO, Ben van Beurden, just a few minutes ago.
The energy markets are tight and will remain tight and volatile, I think, not only for the remainder of this year, but also well into next year. Where will it go from here? Let's see. But I'm quite optimistic, both on the energy system as well as the global economy.
The energy sector currently up 1.5% in the session. Shell gaining 2%. Joining me now is Bloomberg's oil and gas reporter, Laura Hurst. Laura, talk to us about why Shell is increasing its buybacks, its return of cash to shareholders. Why is it not investing in gas and oil that we desperately need, or indeed taking that money and funding that shift to renewables?
Yeah, that's a good question, because historically when oil prices are high, majors will start drilling to make the most of these prices, but they are basically saying our shares are undervalued. The best use of our capital right now is to buy back our shares. So it's very different to what we've seen in the past. And the other thing is that they're trying to ramp up their renewable businesses, but so far Shell has only done this really piecemeal, investing here and there. So people are wondering, are they going to be making a big ticket acquisition at some point? But from what we can see, they're seeing more value in returning cash to
That's interesting. The CEO kind of reprimanded me during the break in a friendly way around how we define this company. He said, look, we are an energy transition company. You just called us an oil company. But you're saying this is a piecemeal effort. There is a desperate need for more renewable energy infrastructure. So the reason they're holding back on this is because they're eyeing up an acquisition?
Possibly. That's not for certain. It's something that we've reported, that they're definitely looking at it, and it's more plausible that it will happen now than, say, a few years ago, because they've got a lot more cash, and also the valuations for these big renewable companies have come down. That doesn't mean it's going to happen anytime soon, but it's certainly something to watch out for.
Talk to us about the political pressure. I can already picture lawmakers in Westminster kind of licking their lips over the prospect of attacking Shell on the back of another record set of profits. Do they face more pressure? The windfall tax is in place already.
Yes, absolutely. So there's definitely an increasingly jarring juxtaposition of Shell's profits, and not just Shell's. We'll, I'm sure, see it with BP as well next week. And the pain that consumers are going through in the UK and other parts of the world. So for sure, we'll see politicians today saying this just shows that we need to tax these people more. But as you say, that windfall tax has already happened in the UK, so what more can they do? What are the next steps? It's not very clear. And the other thing is that the bulk of those profits don't actually come from the UK assets, they actually come from other assets all over the world. So the reality is that you're not going to be taxing that massive 11 billion figure.
Yeah, but certainly, as you say, the optics don't look good, do they, in terms of record profits at a time when households could be paying £500 every single month in utility bills. Thank you very much indeed. Laura Hurst, of course, from Bloomberg across the commodity space and walking us through those earnings out of the oil majors, the political implications as well. Coming up, Meta missing, and for the first quarter ever, the Facebook owner's sales declined. Tech earnings are in focus. Next, this is Bloomberg.